The Federal Reserve keeps rates unchanged, acknowledging that the economy is strong. We're going to have to wait till the next meeting in November to see if interest rates are going to move at all before the end of the year, at least the Fed funds rate. Investors have been asking themselves, are rates going to get lower anytime soon? And the answer is not yet, and maybe not for a long time. We've got a piece talking about that. Also from the John Burns Research Consulting, are we looking at a home supply glut in the United States? A ton of new supply is coming online, apartments, single family homes. What does it mean for the future? We're going to talk about that, as well as a piece. I'm really a LinkedIn post from Jay Parsons from RealPage. Again, talking about this relationship between cap rates and interest rates. Is there any correlation? Not related entirely, have nothing to do with each other, or is there some relationship there? What does it mean to real estate investors? We're going to continue to look into that. Also, from Pro Market, the University of Chicago Booth School of Business, evaluating concerns of collapsing commercial real estate prices. We are seeing cap rates expand, but what does that mean and what do we do about it? And finally, from Apartment List, a national rent report for October 2023. Also, Matt and I are going to throw out some random opinions, insights, what we see going on in the market. So if you are a multifamily investor of any kind, active, passive, it's the right show for you. We're on YouTube, wherever you can get your podcasts, covering all the latest research reports, data, anything that's going on in the multifamily market, the housing market, real estate, the macro economy. We're going to discuss it, break it down, isolating the most important information so you can make some really well-informed decisions. All right, strap in. We've got a great show. Dr. Matt Bosnagel, he's with us again today. All right, let's get into it. All right, welcome back to the Gray Report. Joined again by Dr. Matt Bosnagel, Director of Communications and Marketing, producer of the Gray Report. Matt, how you doing this
Almost
week?
tipped the mic over. I am doing pretty good, actually.
Well, you're in a different spot than you usually are. So
I know. It is
new orientation.
Yeah, hard. That's right. I'll get used to it. I think that the greater multifamily industry has been thinking a lot about interest rates and a lot about the effect of this higher for longer environment and where valuations are. And it's just I keep getting more and more reports and more opinion pieces on what does this mean, where should we be at, where should everything be priced, is it inappropriate right now?
A lot of confusion out there.
It's a lot of confusion, and it's a little gratifying that we have been thinking of that we're kind of aligned with whatever, but and there's not a whole lot else to think about for some of these investors and people that are looking to buy or looking to sell too. And just based on what we talked about a little bit just before this, it looks like maybe there are some cracks forming. And I keep thinking though, and I've said this probably too many times, and you'll have to start correcting me and telling me to stop repeating myself. People are going to have to write off 2024 if they're looking for significant growth outside of some few examples. If we're talking about the average apartment market performance,
there's just we're not going to see that much rent growth. It's going to be just a tough operating year in 2024.
Yeah, it'll be a tough operating year, and if you buy at current cap rates and interest rates, then 2024 is not going to have the growth required to drive any kind of returns. It would be maybe flat. I don't know. We're almost approaching that point of the cap rate interest rate spread as basically even, and that doesn't account for operating costs. So if you're relying on growth that does not arrive, then that's going to be very difficult, and hopefully it will inspire some action from some operators in the market.
Anyway, so Matt, the 10-year Treasury and cap rate spread, it's tough. And what's tough is because there's a lot of different investors out there, and there's gonna be a preference from the market, especially brokers and lenders, people who are doing deals, who are willing to pay up for some of these deals, who are saying now is still a good time to transact, and it's always it's always a time where you can transact. There's no always good, always bad. There's good deals to be found in any market. But it also it's not a absolutely objective exercise. An investment to one person can be looked at completely differently by another. An
Yeah.
institution is going to have very different goals than an individual. It doesn't mean that
Hmm.
the institution is doing a bad deal for them. It just means that they have different goals and objectives than individuals.
Hmm.
But there's also um, there's a lack of kind of consistency in where the market is, and so that no one is really sure what they should expect.
Yeah.
And so with that uncertainty, a lot of the smaller investors and syndicators who are wanting to see, higher returns because you have to go out there and raise capital, equity capital. It's harder to do because, what is that return that makes sense? Whereas an institution, they just have to get money out. And, like many of us think that real estate is a great long-term investment.
Hmm.
And, they don't need to, hit huge return. They just need to allocate some capital, and they have to allocate it
Yeah.
in many cases.
And
So
they're making, yeah, and they're making some cold decisions based on that need and kind of an imperative.
yeah,
Versus maybe, the calculations may be different if I think too, if you're holding a different amount of assets, then maybe if you have a smaller amount of assets, then you may not have the room to 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 sell any one of them. But if you're holding a bunch of them, then maybe in the aggregate you can afford to sell one to kind of save the others, if that makes any sense, if you're trying to recapitalize.
yeah. Well, we've talked a lot, Matt, about I think the last couple of weeks of some of maybe the smaller players having some issues, just not being very well capitalized. We're going to see maybe some distress from some of maybe the newer syndicators. But on the opposite end of the spectrum, not even like the larger kind of middle market private equity firms, some of the big institutions like the REITs out there, we may see some of this stress. It may not even come in the form of distress, really kind of in some ways decisive action, because they have a lot of tools to use and to restructure, and
Yeah.
they have huge portfolios. And just I was talking to you, ran into an example recently. The quarter obviously ended a little more than a month ago. The third quarter, we're starting to get earnings reports out and press releases in the filing, SEC filings, these 8Ks from a lot of apartment REITs. And one kind of caught my eye a little bit. And it's an example of how when you get so big, you can sell deals at a loss to create a positive outcome. And
Hmm.
again, your strategy is much, different, if compared to if you have a portfolio of 10 or 20 properties, you
Yeah.
can't sell,
Yeah.
5 or 10 of your 20 property portfolio at a loss and could really ever and be able to make that back easily.
Hmm.
Because if you lose 50%, you got to make 100%,
Hmm.
to get that back. But so in this one case, and I'll just share a piece of their the press release, the Independence Realty Trust. They're going through a portfolio optimization and deleveraging strategy. And now it doesn't go into all the details just on this press release. I listened to the press conference yesterday and in their 8K filing. But essentially that they acquired 10 properties between December 2021 as a part of a merger with Steadfast Realty. And they need to raise cash to optimize and deleverage their entire portfolios. And so they're going to try to sell 10 of these properties out of their 100 and I think 15 property portfolio. And so they're going to try to generate about, 500 to $530 million of proceeds to use they're going to quote proceeds used to immediately delever our balance sheet. And getting into their
Hmm.
press conference, specifically, they have loans coming, maturities coming due, that they need cash to be able to cover and delever and pay down debt. A lot of interest rate caps, that are expiring.
Hmm.
They're trying to reduce the debt on their balance sheet with an objective, not to get the highest return, but to get a better credit rating, to get an
Yeah.
investment grade rating, so they
Hmm.
can go out and raise more money
Hmm.
to then when the buying opportunities come in the near future to be able to take advantage of that. but they're planning to sell these properties at a loss. One, they're saying, one property in Chicago, they're already basically are writing it off, and they're planning to write off up to 4 out of the 10 properties completely at a as a loss, and are expected to have an estimated, after the completion of all sales, they are expecting to recognize an aggregate net loss for approximately $39 to $51 million. And part of that is going to be $11.3 million impairment charge from writing off a property in Chicago. And then they're going to have an estimated $55 to $63 million in impairment charges from basically writing off properties that are going to take place before the end of 2023.
Yeah.
And so this is to put them in a better financial situation for the future, which I think that it seems like a smart move for them. But this is the type of activity that's going to start moving markets when players need to dump assets quickly. They just need to
Yeah.
dump it, fire sale it, because being able to delever and protecting their balance sheet has much more fruitful long-term prospects than holding on to these properties and markets that they don't
Yeah.
have any other scale in.
Yeah. It's
So-
like the cost of staunching the damage or of reducing, the benefit of that is far outweighs the loss that they would incur by writing off those properties. And to return, it's some maybe of the smaller syndicators, it's either all or nothing. They're like, well, no, we gotta find this good price, and this is gonna go right, or it doesn't matter. We won't have to worry about a credit rating. That's the least of our worries. There may be far bigger things if they only have 10 properties and they're all
exactly.
underperforming.
You can't tell exactly if you're someone new syndicator and you've done a few deals, you can't sell one at a loss.
Yeah.
I mean, because as a REIT, in their mind, if they sell these properties at a loss, it's not like their REIT investors or equity goes to zero. In fact, the stock price of the REIT may go up eventually. Now it's like bottoming out, or it's bottoming out from the past couple of years. Like right now, a lot of the REITs have been. So, I mean, the damage has already been done. If anything, this is going to get the energy for them to, have a better financial position going forward and raise more money and see their stock price go up. But for a syndicator, you sell property at a loss, that equity or a partial loss of equity, that's a real loss to a real investor. And so again, we go back to, there's different buyers with different objectives. Like you really can't. It's hard to compare the two objectives of an institutional investor like a REIT and a syndicator, or like a family office or an individual investor that may happen to own a whole apartment themselves. That may be like a 1031 buyer. There could be so many different circumstances that is just continuing to keep the market afloat in an environment where we're seeing really low volumes.
Yeah.
But man, Matt, the cracks, like it sounded crackly out there.
Yeah.
Not from an audio perspective, but
Crisp
from
autumn air.
it could be the leaves. I think.
Yeah.
It could be the leaves. But we keep underwriting deals, Matt, and they don't look good. I will be honest. We are seeing deals. Cap rates on deals be higher on some, not all, some. But some of the returns that we're looking at, again, because like you said, 24 is kind of a lost year, and it's hard to make up for that. Hard to get excited. That's why there's so much movement towards preferred equity, because the common equity returns just aren't very exciting.
Yeah, that's another thing that I've been reading so much about is like, well, yeah, just go to preferred equity. You have a little bit less risk, and do it that way, or just buy. And no one's ever talking about, well, there is a big alternative. Just get a treasury itself. If you're, if you want that risk-free rate, then why are you?
Exactly.
Yeah.
Exactly. And so what it is going to lead to is the volume of deals finally increases, like the deals start coming on the market. There's going to be only so much capital out there that will accept, the kind of the current pricing and returns, fewer and fewer of it. and it'll get to a point where pricing will have to start coming down because deals will have to be sold, and someone will be desperate enough. And also, it's the banks are going to probably have to start taking haircuts as well, because these deals, they're not going to be able to be, if they have current debt, I mean, the banks are going to be taking losses as well. Because like if you're going to go and restructure it, you can't like restructure that debt away and necessarily be made whole with the current valuations. It just doesn't work. So, everyone's gonna have to take a little bit of a haircut to make a lot of this work. And it's not gonna be, I mean, it's not gonna be a quick process. I mean, we're like,
well, and we're beginning to, and I think the ultimate, decision that they made is, well, it's probably better to sell now than to sell in, in 3 months, even in January.
You've been saying that a lot, and
Yeah,
I've been like, I don't know, I don't think it's been a good time to sell like at all. But now it's like, Matt was right. Like it would have been it's been much better to sell, 3 months ago, 6 months ago. We were saying a year ago.
Yeah.
I mean, I remember telling to other people the price isn't going up, really negotiating, but
it almost seems like, and I don't know how much further there it is to drop. I'd love to know what your opinion is. I've heard people saying, oh, it's got halfway more to go. But I don't think it's done. It's certainly not finished. And even like 30% more, that's a pretty significant, reduction. And the issue then is, will this create a counter reaction where so many go in to sell? But I really don't think that's going to happen. I think people are going to rush to sell. The real emotion is to avoid that at all costs. But man, October turns into November. The October due date for some of these loans, maybe that did coincide with some of these announcements of sales, and maybe we'll see some things kind of bubbling up, because it was when we did our loan maturity report, we saw October and November as this big inflection point. And my question, and it seemed to be, it still is valid, is that like, they're going to wait until the end. And now maybe they got it in the mail today. It's November 1st. They're like, all right, now you are delinquent. And I'd love to know what the delinquency rate is, because that's pretty accurately tracked. And I'll have to jump back and see.
I don't think the issue is necessarily delinquency. I mean, like delinquency has gone up a little bit. People are paying. It's more of just like the loans coming due, and but most borrowers are.
Okay. Yeah.
Most borrowers are just getting, extensions.
Okay.
Again, delinquency has gone up, but most owners, a lot of the deals, not all the deals are cash flowing. Some of the deals are barely cash flowing, barely, or owners are coming up with their own money, to feed the deals, or they're using CapEx dollars, to cover debt service, which all that can only go on for so long. The banks don't want to deal with it also. Again, it's a relationship business. So far, I think everyone who's been acting in good faith, if they want an extension, some sort of modification, they're getting it. But it's not going to be able to go on forever. But also, like you've said, and we've both said many times, Matt, no one's gonna, cry uncle until they absolutely have to, and are really sat down and told that it's over. People are not going to go down without a fight. They're not just going to give their assets up when they think that there's options out there. And, there's been people waiting for interest rates to come down. That hasn't happened. There's really there's no sign that that's going to happen anytime soon. But, there's still a hope and a prayer, and we shall see. Even Jerome Powell today said at his press conference that, interest rate, the treasury rates are up, recently, but they could come down, and then there's volatility in those rates, and they can go up and they can go down. That's not necessarily saying that they'll be up there forever. We're still expecting the CPI to, ease down with, shelter inflation, finally starting to like subside. It's not as much as we thought it would. It should be coming down, more and more. The Federal Reserve isn't raising their interest, the Fed funds rate. That's good. They didn't really give a strong indication that they would at the next meeting, only that they're going to be very data dependent and see what's going to happen. Like they always say, the dot plot has another rate hike, plugged in there. But I think, and again, and we're moving on a little bit to the Fed press conference
Let's talk
and
about it.
the announcement to keep the Fed funds rate between 5.25% and 5.5% unchanged.
Mm.
I took some notes, of which I'm not going to share because you probably wouldn't be able to. A long list of things. It's a lot of no new news, really, Matt.
Mhm.
Other than things that we all know, that Treasury rates are up, the Fed funds rate is where it is. GDP came in way surprisingly hot.
Yeah.
Unemployment is low, but there are some good signs on the supply side. As much as everybody, it seems like in the media, certain channels get really upset about immigration. Immigration's like an inflation killer,
Mhm.
and we need the labor, and so that's a very positive thing for the economy. That's just like the economic truth right there. Also, labor participation, rate has increased. There are more people like in the labor force, or at least they're attempting to be. The quality of those jobs and all of that, is questionable. It's a lot of like service jobs, things like that, but which is all good, to an extent. But PCE prices, they're running a 3.4%. Core PCE has risen to 3.7%.
Yeah.
Nominal wage growth is easing. So, that's
The PCE is interesting, and even the CPI, for at least this month, both of them were like the same. It was
Yeah.
stable. I know that's better than going up a lot, but it's certainly it's certainly not any progress. And this, I don't know if this plays into higher law or for longer or whatever, but it's hard to see it from. And this is just like, even from the notes that you're saying, it's like it's such a mixed bag that he's saying it's good, but not good enough. We're doing things, but maybe we're not doing things. One thing could happen, but maybe the other thing could happen too. It's frustrating.
They should have like titled the meeting really not. It's a mixed bag of we have no idea what's going on. Or
Yeah,
hold on, let me try that again. It's a mixed bag. Can't make any sense of it. We'll wait for more data. I mean, I in some paraphrasing, but basically inflation's coming down, but it's below target. Labor market's rebalancing, but it's still strong. GDP, it's strong, but we forecast that it'll slow. We want to get inflation down to 2%, but not confident that we're there. And then he also said, he's like, we're not confident that we have gotten there, but we're not confident we haven't gotten there.
This is a known
Monetary
unknown.
policy.
Is this a known unknown?
It's a lot of.
This is a whole new category of knowledge and data where you're not confident that you have done something, but you're also not confident that you haven't. Oh man, this is almost philosophical.
Some of the questions and the answers to the questions, again, he's like it should have, but we're not really sure. We don't really know. We're not.
Yeah.
What effect it's had. But the one thing, the one thing of note related to housing that I also wrote down is, he said these near 8% mortgage rates could really continue to upset the housing market.
Yeah,
and we should, and again, the long variable lags, these things trickling in. These 8% mortgage rates, that does have an effect. And the longer these higher rates are in the market, the more of an effect that they're going to have. What we're talking about, these multifamily loan maturities, that's part of it. That is gonna hit the economy in multiple ways as it resets, and that part of that's just one example of one part of the economy that is in a process of recalibrating and resetting. And the unfortunate truth, when you need relative stability in any market to be confident in your decisions, willing to take some risk. We just don't have that stability and confidence, and we're just not going to get there anytime soon. The market has gone through periods of kind of resetting itself before, and as we're obviously going through that, but it's not done, and it's a frustrating period where no one really is sure how it will turn out in the end.
Yeah, it's interesting. Just thinking about how much more new home sales there are than existing home sales, and how much it is a little bit of uh, uh, of a very similar picture to like multifamily newly constructed versus existing multifamily properties. There's such an incentive to hold on to things. It may be an incentive born of different motivations, but like you want to keep your good loan, and the multifamily people don't want to finally kind of realize their bad one maybe, and the end result is the only thing getting out that's getting these categories of housing out of the housing shortage that they're in, whether it's apartments or single family, is new home construction.
Yeah.
And once that comes in, and this is referencing ahead to another LinkedIn post that I want included here.
Yeah, let's bring in
but
the John Burns piece, right?
Yeah. So exactly. So if we're right now, like, we are at a good place, and it was a little bit of a scare tactic saying if not for the lack of resale homes, we would likely be talking about a new home supply glut. And what really is making people feel like there's such a scarcity of homes is no one's selling their existing homes, and for good reason, because of interest rates. But man, have we had so much new home construction, and if you account for that, it bumps it up. We're at a really great level of new homes completed. But I think that my take on this was that, yeah, we do need to. I don't think it means a glut. It just means we're going to be backfilling for that shortage that we experienced during the housing crisis, and there's still work to do there. So I don't think that it may be not a glut, but like an overproduction. I don't know. Elevated production is a little bit more precise of wording, because the need is there for these housing. They're getting filled up, and man, they're getting filled up. People are. I was thinking about this. You're buying a new home, whether it's new constructed or existing. You're getting that new home at a brand spanking new 8% mortgage rate. I know the all cash purchases have gone up. Obviously, they should in this rate environment, but like a lot of these people are paying the 8% rate, and they're paying these still elevated home prices. I am almost positive that the case Schiller hasn't tanked as much as the 10-year Treasury has come up. And just yesterday it says U.S. home prices set record with 7-month streak of gains. This is in the same period where U.S. 10-year Treasuries, the industry benchmark, was rising, or at least like plateauing at a very high rate. So weird. Single family buyers need homes though, so that's not weird. The elevated price though is it just is an example of the extreme amount of homes that are needed, and the extreme amount of housing demand that there is. That will, I think, we're down to the benefit of multifamily, but it's super interesting. I talked about this last week. Super interesting how rents for multifamily have not had, are not sitting high, sitting at such a high level in the same way that home purchase prices are.
Yeah, it's fascinating.
Yeah, and like the triggers, I mean, there's still rental, even for rental housing, or for like single family rentals. Those aren't like going up by leaps and bounds. It is this. There's a clear bifurcation between rental and buying, and maybe I'll argue a little bit that it's because rental housing is a little bit more faster transactions maybe, and you could find what the market is. There's a more price discovery because there's more things that are happening at a more rapid pace than maybe you've got to drag people to buy or to sell, or that's not happening.
Well, why would someone sell when they've got a sub 3%?
Yeah no
30-year
reason.
fixed mortgage? I mean, I've seen some people on the internet. I've read some things of people who still will move. People who have the money. I mean, people who have the money to buy a large house and if you can afford the interest rate. Because at the end of the day, and this is the difference, Matt, like you were alluding to, difference between kind of rental properties, investment properties, and a end user, a family or individual buying a home is, it's either one's driven primarily, both are driven by emotion, but one is primarily emotionally driven, and the one is financially driven.
Yeah.
Again, there's financial motivations in both, but I mean, the individual or the family, they want that house because like that's where their family needs to be. That's where they want to be. Investors trying to do it to get the highest return on, their capital.
Yeah.
And so they're just looking at it. You're just looking at it a different way, but there are people who are selling their homes, giving up their 2.75 mortgage and locking in a 7.5% rate, or, buying some points down and, doubling or tripling their monthly payment. But they're like, well, I can still afford. They're like, I was saving money with the cheaper payment, but I still can afford the higher payment. And this is what I want for my family.
Yep.
So, screw it. It is what it is, and it's
Yeah.
expensive, but I'm just going to do it.
And those
everyone,
attitudes, that's where we get into the fuzzy feeling of like the attitudes towards whether they can swing that. It bleeds over a little bit to the attitudes of multifamily, but I've been surprised. It seems like there are, those attitudes seem to be working in reverse a little bit when it comes to holding on properties, and that's true for single family maybe, and a little bit of the multifamily world, and still thinking like, oh, if I can get that projected growth, things are going to come back, the rate's going to go down. What's why sell now? There's always that feeling that maybe motivates the rationalization, and
if you've got if you've got the runway, it makes sense. If you're like, look, I'm financed the right way, I can hold on for another 5 years. Why do it?
Yeah.
Why not? I could understand either suggestion.
And one more thing about this graph from John Burns is I thought that it was interesting to think about the eventuality really of maybe there being an oversupply of homes. I don't think that it's going to happen anytime soon. Again, like we will have multiple years of above 300,000 new homes built, and this is just single family. We will have to have multiple years of that, which we have not had yet, before the deficit that we experienced from like 2010 to 2019 is kind of filled in. And I'm using 300 as the average here. It seems like a clear average before the Great Housing Crisis, which then peaks, and then it slumps for those 10 years from like 2010 to 2019 or whatever. But again, we've got some room to fill. But so even with all those caveats, it is worth thinking that eventually things will get the housing affordability crisis will, if a lot of plans go correctly, not be so keenly felt, and then there will be more homes maybe, and maybe housing will be cheaper. And I think it's worth thinking about that and timing it in with whatever you think maybe apartment rent growth is going to be, or whatever you think housing prices are going to be if you're buying a home. But like maybe 10-15 years down the line, things may be in a different spot when it comes to the housing affordability crisis may not be a crisis anymore. And so strategy.
Yeah. And the thing is, like, we just, the next year or so, I still think that I don't necessarily know how it's going to happen. I'm suspicious, but again, we can still easily see a recession within the next, year or so. I think we've got all these lag effects, so it's definitely floating out there. There's no real signs of it happening anytime soon. But again, we're hearing these cracks form, and if that happens, then we're in a completely different environment.
Yeah,
it could be within a couple of months. A few things happen, and all of a sudden, if the Fed drops the Fed funds rates, it could be a complete game changer.
And that is true that like apartment builders and home builders, they're responding to incentives too, particularly apartment builders, which is interesting. It's kind of different than, new home builders. Maybe you can ask and then they'll build it. And, it's kind of maybe, by request or whatever, but I don't know. But like an apartment build, and now I'm sure there's other models and like on spec or whatever. But like they can respond directly to the demand of a consumer when it's a single family home. And, but then an apartment builder, maybe they build it and they're worried about the interest rate because they've got to sell it really, really quickly. And so whereas single family home construction has remained fairly elevated. Multifamily home construction started to pull back. And so regardless of my my word salad there in the last 20 seconds, the bare facts of it means that they are being motivated by different drivers. And I think that multifamily, it's clear how much the rise in interest rates is mattering to these multifamily developers. And it means ultimately, we're talking about things that may happen 10 years out or 5 years out, that these builders are responding to stimuli, and it's not just going to be constant. So one of the things, though, I think is, rates are high. That means in a couple of years, we're not going to have that huge apartment supply glut at the very least.
True.
But, who knows? Maybe they'll start building next year.
Who knows? Don't even. I don't even want to, predict because we just don't know.
Yeah,
Matt, we're just looping back around. Looping back around. We probably should have talked about this earlier. Relative to discussion up front about interest rates and all of that. But better late than never. Jay Parsons had a LinkedIn piece. We're talking about 10-year Treasury yield. We're talking about interest rates, their relations to cap rates, and this post came on basically really kind of taking a look at what's the relationship between cap rates and interest rates. It's a hot topic. It always generates passionate viewpoints on both sides. And basically, long story short, Jay's in the camp of the great Peter Linneman, who has argued that cap rates are not directly correlated with interest rates, but rather with capital flows. And I think it's it's almost like I think both things can be true. I think that absolutely capital flows probably have a more important role, but the rates and demanded return of those capital flows are also critically important. Because I think that the point that Matt, that we were trying to make when we we made a video just this last posted this week.
The graph in the background is the very same graph that you were using.
Yeah. And we're basically pointing out that the previous, like the smallest spread between the 10-year Treasury and current cap rates or in cap rates was basically like 150 basis points, and it's been as wide as 400 some basis points. And we're not saying that one is driving the other. Certainly not cap rates driving the 10-year, and not really even the 10 years driving cap rates. You can watch this video on the Great Capital YouTube channel, but more saying that when the volatility of the rates kind of moves, and when the 10-year, the volatility is so great, and when the rating when the 10-year moves from 0.5% to 5% within like a year and a half, that does have an impact on cap rates and demand for multifamily properties and the market sentiment for acquiring and investing in multifamily assets. You had a comment on the video saying, well, cap rates aren't a return metric, which is absolutely true. We never said that they were a return metric. They are a metric that is a function of income based valuation, which is somewhat relative. It's not irrelevant to return. And we're just looking at, again, what are the extremes? And when things are so out of whack, everything is related to some degree. And again, things can change over time. Their relationships can change. But when we get to such extremes, we have to make, I think it's important to make note of that fact. Because the 10-year Treasury, one, relative to capital flows, it's the price of that capital flow for debt. So much of multifamily is financed through fixed rate, long-term debt that's indexed to the 10-year Treasury. So it's directly related. That cost of capital, the capital flows are related to that cost of capital. I certainly would believe so.
Yeah.
And also, the 10-year Treasury relates to, risk in the market and what the risk-free rate is, and alternative investments and returns out for real estate investors. So that was the kind of the point that we were making in that video of saying, like, look, these things are out of whack. Is that and then I think what rubs people the wrong way is we said, look, if we just took the average relationship, the spread of 10-year treasury and cap rates, that means that cap rates should be somewhere between, basically 6 and 9%.
Yeah.
Now, and then we also I don't think cap rates are getting up to 9%, but they're not 5%. They probably shouldn't be 5% either. And maybe, and again, and someone made a really good point. It's like cap rates they're such location and asset driven. 100%. We are speaking in broad generalities, which are not accurate in talking about specifics. But in general terms, we're talking about the direction of most markets in general. Not the markets don't move in lockstep. I mean, Indianapolis, we're seeing rent growth. The rest of the nation is seeing rent declines. But generally, the U.S. market sort of moves, loosely in a similar direction, with some outliers here or there.
Well, and and this is something that I forget if you mentioned it on the show or shortly beforehand, but it is one of the many factors that determine a assets returns, or whether or how an asset is going to perform. It's not a guarantee. Some people may think that it's going to grow, and there's a lot of things that go into cap rates. But my whole thing is that it's a lagging, and it is maybe it lags a little bit behind the 10-year, unless there's like really sharp movements. Then you're not going to see. It's not going to react as quickly as just because apartment transactions happen so slowly. And my other point was that he says that they're not. His argument is he's kind of presenting a counter, the idea that they're directly correlated. Fine, they're not directly correlated, but they are correlated. There is a connection, and the reason why I'm even saying this and trying to kind of like argue my point here is because I know that it is a factor in people's in people's analysis of a property. There's no way to say that it's not. I'm talking about 10-year rates. I'm sorry. I liked this comment that was citing Joe Pagliari is that, the technical answer is that cap rates are a function of the cost of debt, the cost of equity, and projected growth. So number one, cost of debt gone up. That means cap rates. That means there's one category in the the going up section. The cost of equity, I would say, has gone up. It's been maybe even if that has been maybe even if it's the same, then number three, projected growth, at least for 2004, we're not going to get there. And again, like there is a force driving it down. It should be driven down, I think, a lot more than is being described here, because otherwise then people are counting on a whole lot of growth, a lot more growth than there has been to compensate for the wild upswing in the 10-year treasury. Otherwise, like, I don't know how it makes sense. Like, they're really predicting like that much growth.
I also, I think he's quibbling with sensitive versus correlation, and he says, Jay Parsons says that to the point we were just making, so we know the capital flows have obviously been impacted by higher interest rates. The sheer size and speed of the rate hikes ensured that nearly every type of investment, including outside of real estate, will be impacted to a varying degree. So therefore, you could argue that cap rates are sensitive to large swings in interest rates, but correlated is a much stronger and inaccurate description. So I guess maybe Matt, we're using just the incorrect term for correlate, correlated, or we're using it improperly. I think we usually talk about the relationship between cap rates and interest rates, not necessarily that fact that they're correlated.
And that's another thing too. And just before, it's like there's a clear cause and effect you can see all these swings and like and assign a reason and a motivation why they would drive investors to do one thing or to price their assets lower or higher. And it's frustrating to see it overgeneralized.
Yeah. Yeah.
If you want to bring up, yeah, exactly. Okay. So here's the competing chart. And if you want to explain, you did a great job in the video, and I don't want you to retread any, check in the show notes for the link to the really great video that he did. But I'd love for you to, explain some of the history and some of these specific drivers like that made the spread maybe narrow or larger in certain circumstances.
I mean, a long story short, Matt, is, when you're looking at, buying a stabilized asset, the larger spread between, the interest rate on your debt and the income that property is generating, it's already generating, is going to, typically allow you to produce, higher yields, early on your investment, not taking into account your business plan of where you will create further growth. So it doesn't mean that you can't buy on a lower spread or negative leverage of all that, find growth and create some positive, yield on cost. But cap rates are real sentiment, are real, market indicators, and are really a function of market sentiment and kind of the value that the market is, placing on the kind of the value of current cash flows that commercial real estate is producing. And so we look at this spread, just a couple things, and again, I'm not saying that anything's absolutely correlated, not to get on the wrong side of Jay Parsons, but just a couple of observations. When these spreads do get narrow, tend to be less than opportune times to acquire real estate assets, multifamily. And when the spreads get wider, you tend to have the opportunity to produce higher returns. Again, we said cap rates aren't a return metric. They're not. But, I think there is a relationship. Yeah. And just as a quick example, the last time spreads got super narrow were back in 2006, right before the great financial crisis. Not always the best. It's probably not the best time that you could have bought apartments or real estate, because they went through a little bit of a correction in 2007, 2008, and started to recover, 2010 or so. Now that spread really widened, starting in 2011, 2012. That's been a great time to buy apartments. You saw a lot of rent growth in the next couple of years. And in general, that next bull run in the apartment market, kind of 2010 through, call it 2021, saw those really nice spreads. And then in 2022, as interest rates have risen, cap rates, so we're slowly, moderately declining. And that's the big difference here is, we see everything is pretty slow and steady. But in 2022, when interest rates really started rising, that really changed. And, that spread became narrower. And again, we could talk about how, Jay Parsons saying you're going to be on the sidelines for a long time. And I think that's a good point to be made. But the reality is, when, as a buyer, if you're underwriting these deals and the equity's not interested in the common equity because the returns aren't high enough, and and your IRRs are, high single digits, low double digits, there's not a large market for that. And so it's just the reality of the prices have to come down and cap rates have to go up. And so I'm really trying to simplify it, but it's because the 10-year treasury is the base financing rate of how we're financing these assets. And these high interest rates is what is making these acquisitions close to impossible. Not near fully impossible. People are still doing deals, but it's very challenging. And a couple things have to happen. Either interest rates come down, the prices come down, or rent growth, or we get a ton of growth. And we're not going to most likely get a lot of growth next year. And so we kind of, if the growing out of it isn't as big of an option, prices have to come down or interest rates have to come down. One of those two things have to happen. and eventually probably both of them will, probably not at the same time. It'll create an incredible buying opportunity again, and these spreads will widen again.
Yeah.
So
It's worth
is it I guess so, I
Mhm.
think people could say, and people have said, that there are better rates to look at than the 10-year treasury. People, we talked about the triple B corporate bonds. People have suggested tips, all really good stuff. I think it's going to show a pretty similar
Yep.
relation.
Uh,
And I think
yeah.
our only point, and
Mhm.
I think we made an extreme point to make a point, Matt.
Yeah.
I mean, I don't know. I don't even think it was extreme. I just think we were looking at the math.
Yeah.
And the point is, it looks like cap rates are going to continue to rise a little bit.
Yeah.
Like,
Yeah.
I think that's it.
And it's
Are we
hard to
wrong?
argue. No, and yeah, well, I don't think we are. And you talk about extreme. I think our evidence is extreme because we are at the extreme most narrow.
I mean, I don't want
spread.
cap rates to go to 9%.
Yeah.
Or 8%.
And I don't, and we don't, and even in that video, you didn't say there was, because there is a great deal more investor interest, I think, in multifamily than maybe there was in the past. But
Yeah.
the fact is, that the spread has never been as narrow as it has been today. And if the spread was that narrow, you would think that the consensus is that the apartment has nowhere but growth ahead for, it maybe have growth ahead, but as we'll see, maybe, if you read the current rent reports now, there is some rent declines that we have seen currently, and they are projected to have a more stagnant, more subdued amount of rent growth in 2024. So it's harder to picture in that growth in 2020. It's not impossible, but like we kind of said, and I alluded to this a couple weeks ago, maybe when we talked about the low amount of apartment sales that we had in 2023. It's possible that 33% of former sales, or however, the fraction was, maybe in those sales they projected growth that could exceed it, but the 70% that's missing, that's not the case.
Exactly.
So if you average it out, then
exactly.
Yeah.
A lot of cherry picking the data.
Yeah.
Matt, this seems like it might be a good little transition to this piece from Pro Market.
Yeah.
Evaluating the concerns of collapsing commercial real estate prices, like kind of sort of what we're saying.
Yeah. This is
I don't know why we and then we weren't like attacked for the video or saying it, but it is interesting, Matt. And again, and I don't know, I think Jay Parsons watches, sees some of our stuff. I don't know if he's a viewer of the Gray Report or not, or I'm assuming maybe he's not. But Carl Whitaker has been on the show, works with Jay Parsons, and anyway, but the couple pieces that we put out on the cap rate interest rate spread before we get into the piece from Pro Market, it invoked a lot of emotion, and it just got a lot of response from people. And that wasn't necessarily, I almost feel like people thought that we're almost like kind of clickbaiting with the data. There were, of the position, it was so extreme, and it really was ruffling a lot of people's feathers. And then it got me down this other conversation of, it seems like the whole industry is going through like the stages of grief. And and there's this are we in the denial phase still, or are we in the depression? Are we in the depression phase yet? I don't know if are we to acceptance? I don't think
there's a lot of bargaining.
We're not at acceptance.
We're bargaining right now, I think.
So
it's like,
so denial. So denial.
Yeah. Isn't bargaining maybe in one of them, but like we're like, but maybe in this situation, and here, that then things will be okay. But that is you're trying to paint things in a rosy light. And to circle back to what we talked about at the beginning of the year, at least some of these REITs, if IRT is just an example of one of them, are having, they're not gonna have to worry about that now. Well, they'll have to worry, but like what they're doing is reducing risk or the things that may not perform badly, or that things, selling now versus selling later. And it may be a pretty smart move. But
Might be.
yeah.
So Matt, what's up with this piece? Evaluating the concerns of collapsing commercial real estate prices
Yeah.
by Joseph Pagliari.
Yeah, so he
What's
was the
the
one that
deal?
was cited, and I wanted to chase down something that he had written, just to kind of to back up those little three tenets. And there were multiple commenters in that Jay Parsons post, so it was worth finding. And the fact that this was so that the topic was both timely and relevant is perfect. He's really digging into the mechanics in a certain way. It's a little bit academic when he talks about the moving pieces of inflation and 10-year treasuries and the benchmarks that are different that are used. But like his conclusions are largely seem to align with, maybe I'm reading things wrong, and maybe maybe I'm only getting a surface level, which is probably true, a surface level understanding, but really aligning with, I think, what we've talked about. He says at the end, at present, the market seems to be willing to accept lower ex-ante real returns, forecasts higher cash flow growth rates, and or believes, or at least hopes, that TIPS rates will settle lower. TIPS is this other benchmark that is used to determine, for cap rate spreads. And then he says perhaps some, or so what he says, at present the market thinks it's going to grow, or thinks that things are going to be okay, or at least better than it may be. Perhaps some or all of these factors will be realized. But on the other hand, the slow-moving nature of private markets upon the advent and during a market downturn may have yet to reveal the true magnitude of commercial real estate's repricing. So, slow-moving, there's a lot of hope for growth that may not be there. And then he said, in any event, current conditions give rise to concerns about a soft landing or hard landing. And it would seem that, absent some motivating circumstance, either global military conflicts, collapsing banking financial system, avalanche of maturing mortgage loans.
Good thing none of that's going on right now.
Yeah. It would seem most property owners be content to bide their time and this is interesting, though. And so he uses big words that scare me a little, but I think they're worth reading. He says the biding of the time here, which he says the optionality of their levered equity position is best served by waiting. So the math may work for some people to wait, if I'm making sense of that correctly. And then he's, if accurate, the repricing of real estate is likely to play out more slowly, arguing for a soft landing. I think that it will, the repricing, yes, has to be more slowly, just because we don't have the rapid transactions that will allow for instant market recovery, absent some, implosion in the economy. But I think he kind of has it on the money here. It seems like a lot of people are hoping for growth, and no one's really, snapping their fingers and snapping out of it. But we'll see. There may be people that look at these large REITs and say, oh, well, I don't want to, they have a good idea. They're smart. I want to get ahead of this too. But this isn't to say that things are horrible when it comes to market fundamentals. It's just to say in this rate environment and in the near term, the next maybe 18 months, it's going to be a bumpy road, no matter how you cut it.
Matt, do you think we are too negative? Are we too?
That's why I try to circle back to the caveat, because ultimately, if you do have, if you're able to float that loan, then after 2024, then things are going to be pretty okay.
Yeah.
The supply is gonna kind of even out, because now we're getting into the fact that people are building less now than is going to be.
That's the whole. That's the whole survive till 25. That's what everyone's been saying. Just get through next year, you'll be good. Which I think is a big you don't want to just hope. We just need to get through next year. To me, that doesn't. I don't want to just sit around and hope for the next year that in 25 things are going to be in a better spot.
Yeah.
Need to take some concrete actions to make sure that we're in a good spot. Not can't control the economy, but just the economies of things that I can control,
Mhm.
are around me, around us. But yeah, I think if you can hold on, if you can use time, have time on your side versus timing working against you. I mean, that's been a core just philosophy in or part of our strategy is it's like, if we give ourselves time,
Mhm.
if we are long-term holders, we have, the only downside is potential for slower velocity of money. So it's like you can
Yeah.
make the most money just cranking out deals, but there's like higher risk in doing that. Rather be certain that we're going to be successful, or maximize the certainty, but giving ourselves the opportunity
Yeah.
to take advantage of some higher velocity deals and still knocking it out of the park. We plan for 10 years, ends up being 5 years or 7 years. We bought a bunch of real estate, Matt, in 2021.
Yeah.
And in 2022, we bought
Mhm.
more real estate in 2022. We're not worried about that real estate because it's all on long term, mostly
Yeah.
fixed financing,
Mhm.
and we don't have to do anything for the next couple of years. And we got a lot of growth, and we're still seeing growth.
Yeah.
And is it something that we want to go and sell like now? Probably it's not probably a great time to sell. We probably could if we needed to, but
Mhm.
we don't need to. Like so we're in a troubled spot, and then we've got debt that's locked in. You know, I mean, just calculate.
Mhm.
The a couple $100 million worth of debt that we have locked in sub 3.5%
Yeah.
for 10. I've got quite a bit of it locked up for 34 years.
Yeah.
Some for 10 years, but
It's
we're good.
Yeah, and that's true. Like I don't mean to be disingenuous. This is very much like a near term. We have a pretty good idea
But
of
do
what's
we?
going to
But
happen in the
Matt,
next
but
year.
do we owe the listeners? Do we owe the market to be a little more positive? Because again, I'm getting some vibe
Uh,
off of LinkedIn.
well, I don't.
Not directed towards us, but
Oh,
people are
maybe I'll
saying
double
too
down.
much.
Is this time for double down? I don't feel like I'm doubling down. I feel like no. The reason why we started talking in this way
We're just being
to begin
real.
with is because the market's being quite hopeful, and I think that it is at least worth it, whether we're right or not. It's worth it to consider. Hey, maybe this growth that you were counting on may not happen. And I also want to say too is like it's not like things are going to come crashing down by any means. Next year when it comes to rent growth, there could be a healthy amount of rent growth. It wouldn't be that much of a surprise, but in combination with the interest rate environment, that's what's making things difficult for people. And so that's a real determining factor. If it was just one, maybe that's okay, but the combination of these two, it's hard to see a way out of it for these people in this circumstance.
People just seem like they're kind of sick of bad, like negative news. Like they're just
Yeah.
seeing like stories of foreclosures. They're seeing stories from us talking about how cap rates could be at 9%, or they're seeing all these stories, and excuse me, they don't like it. They
Well,
don't like.
I could,
Can we just talk about positive stuff? Is that like we do John
I
Kaczynski or
will
whatever,
I will point people back
and then
to
we sell it to
like
CBS or whoever.
the previous years of me. I've tried to be rosy on the economy for a long time. Throughout the pandemic, I was
we were positive throughout the pandemic, right?
But I also think now at this moment, it seems to make sense that things that some part would crack, or that businesses would have less money on hand because the cost of capital has gone up so much, that it's hard to make sense of the continued GDP growth, the continued employment growth. I could be wrong. I've been pessimistic for about a month, and I already feel uncomfortable with myself. But I'm willing to be persuaded that we will see some light at the end of the tunnel rather than continued uncertainty. But it does seem like a lot of the effects of these interest rates have to do with stuff it's not like the gas you're putting in your car every day. It's loans that come due that have terms that are 2 or 3 or 4. They're long. There's these long and variable lags I'm trying to explain, and the triggers to these they would never have happened all at once. And so I think that we're going to see some real big movements as the end of the quarter and the beginning of the next happen, where things start to realize where, the due date is coming, whether it's loan maturities, whether like it is an earnings report or name your benchmark. It's hard to, and overall, whether we're talking about consumer sentiment, they would agree with us, despite the fact that its economy has been healthy and inflation has been under greater control. Like, those are valid points that like the other shoe has not dropped for a whole long time. Maybe there's not another shoe at all.
No shoe. Maybe there's no shoe.
Yeah. But
On the other foot.
Yeah. I don't know where I'm mixing my metaphors here, but yeah, the fact is like things have not gone wrong, but the average consumer doesn't feel that way. And it, that may result in some hard numbers. It may not, but it's hard to kind of.
Does the consumer know what's going on?
No, they never know.
Oh,
now they agree with me. Now they know.
I have a theory for the consumer, man.
Yeah.
It's a little sexist, though.
There's new theories that just came out that said social media is to blame.
You don't want to hear my theory?
No, I do. I just wanted to.
Social media is to blame.
Yeah. But you probably have a better, more spicy take.
Everyone is. I think it's not necessarily sexist, but there is a sexist element to it. But again, there haven't been massive layoffs. People have had a decent amount of savings. There's an overhang, but also people are just used to spending more money, and it's hard to slow down. I don't think people have wanted to say no. It's been harder, especially households. It takes some real pain for people to say, no, I really have to reduce my spending, and I really need to reduce my lifestyle. I think that we're also combining all this with all the pent up demand for the traveling, and so people didn't travel, and so it's really sexist against men, but it could be. I don't even know why to label it like that, Matt. Mostly just people keep listening.
Like a professional classism.
I don't know. No, but I don't know. Let me just. I'll just say it.
Yeah.
Like, no one wants to disappoint their significant other, your wife. Like, you've planned these nice vacations. You've planned. You've been spending money on certain things. You don't want to slow that down.
Yeah.
You still want to go take the nice vacation. Because you didn't take any during the pandemic, and so people are just. What else are you going to do? They're just still set on spending money, and somehow it's still there. They're finding the money to spend it. Wages have increased slightly, and no one wants to say no to their wife. They don't want to say like, hey, things are tight, even though that they should. And I think most people are now having those conversations, but no one's wanted to have that conversation.
I don't want to go to my dog and say, you're getting the cheap dog food.
Exactly.
It's going to disappoint her. It's uncomfortable for me.
Yeah. So sometimes some of us, don't want to disappoint our wives. Matt, you do have a wife.
I do have a wife,
but also
she's
but
very
you also
understanding.
have a dog.
She's a lot more understanding than my dog.
Yeah.
But no, but I agree.
Sometimes it is the dog.
There is.
Do you know what I mean? Do you know what I mean?
Oh, totally. I totally agree.
In a recession.
There is a spending momentum, and there's a little bit, I think, of this. I would explain the pessimism with like, well, there is an ultimate awareness that, the party can't keep going for this long, and the numbers are, you get used to, and we have said this before, like your interest or your inflation anchor is not always like last year. It could be, you could still be remembering when things were a lot cheaper 3 years ago, and so that's surely weighing on people. But I wonder if, I don't- if this is the same thing where like the loans are coming due, or maybe the credit card's coming due. I think that that credit's something to really watch, and to see if that starts rising. And it sure seems like it would. If spending is rising this much, interest rates are rising so much. um, you know I'd bet that's, the other
I've
piece
heard
of the
some people
puzzle.
say that the rising credit card balances have gone up. A lot of that is from high income individuals just doing the bulk of the spending.
Oh, interesting.
Like they've gotten, like they're paying it off some,
Yeah.
but
Well,
like they're like, just the higher income folks are still spending. And again, that's where it's like they don't want to tell, don't want to tell the spouse that we're not going to Cabo or Italy or wherever the fancy, the fancy vacation was
yeah.
planned for. I mean, these vacations, Matt, they're nuts. None of this is personal experience, but it's just saying, like, other than the vacations can be really expensive.
Yeah. Yeah. I'm just looking at the consumer
Hotels.
credit cards and other revolving plans are they are higher, or a little elevated. They're going down on a year-over-year basis. Or, I'm sorry, the rate of their growth is going down, but they're still increasing on a year-over-year basis by 10%. It seems like the pre-pandemic mean was around
Are these like balances
around 6.
or
This is credit cards and other
usage or?
consumer loans, credit cards and other revolving plans for all commercial bank, percent change from a year ago.
Are you thinking it's part CPI?
No. This I just pulled it up from the Fred website. But it's a little bit elevated. It's definitely not reducing like it was before, but it just feels like things are not operating with the same amount of optimism in the economy that they were in before the rate hikes. And it's hard. It's just hard to get around that fact. Like, what will compensate for it? Okay, that's fine. You can say that there still can be growth. Well, where are we going to find that growth? AI is not as smart as it needs to be to dig us out of this. But
that's the great thing about real estate. The answer to your question, Matt, is you can go find growth.
Yeah.
Like, you can go find growth, and that's where we can get lost in talking about
true.
the real estate market.
Mhm.
What real estate market are we talking about? We're talking about the global, the continental United States. Or we're talking about a region. Are we talking about a state, a market, a submarket, a neighborhood? One corner over the next. They're all, hyper local markets that you can see an incredible amount of growth. There are markets that are going to see blockbuster growth next year. Are there deals to be had in those markets? Maybe there are, maybe there aren't. But that's the challenge, and that's where the opportunity is for real estate investors who kind of get out there and get after it, is to uncover those deals.
Yeah. That sounds like a really good segue, if you would, to the apartment list rent report. It does showcase some apartments are doing better than others, and I just want to cover it really briefly, just to give people an idea. Okay, we've talked about things, how things are going. Well, this is
this sponsored, Matt? Is this sponsored by? Are we sponsored by Apartment List now? I feel like we feature them.
I can
extend
this. I can extend the sponsorship if they'd like it. I'll get in contact with them. But I don't want to miss an apartment. It does a great job of giving us a snapshot of what's
we give it to them for free.
Yeah.
Okay, United States median rent 2017 to present. There's always some fluctuations there here, Matt, but a little bit more of a little more of a dip than we typically see. End of last year, again, typically bottoms out in January. I assume we're going to see similar trend this year.
It looks a whole lot like it. They so year over year rent growth is negative 1.2% right now, and the month over month for October was negative 0.7%, which is over half of that year over year. But the slide in October was very steep, according to their records, which goes back to 2017, but still it was very steep. And they also mentioned the only thing steeper was last October when rents went down by 0.8%. So maybe we will have a repeat in a slightly less extreme way of the winter slide in rent growth that we had in 2022 and early 2023. I'm thinking that that makes a whole lot of sense as you kind of find the mean, and as the supply issues kind of get factored into the market. But not all markets, as you mentioned, not all markets are behaving in the same way. We're talking about averages here a lot, and we're talking, whether it's cap rates or rent growth. But it is important to figure out, and that's how you find winners, is you figure out the places with the highest rent growth, or like we talked about, if you're looking for growth, well, look for job growth, population growth.
I was going to say, because sometimes rent growth, it can be an indicator of continued future growth, but it's always lagging. Again, we're looking at months through through October, September and October. That's already happened. Now, again, the trend can be your friend, and the trend can continue. But there are some other indicators, Matt, that you just mentioned, job growth, being a primary one that can be a more forward-looking indicator than rent growth. But it's still, you got to know where the rents are moving. Because at the end of the day, that moves the needle.
And so then just to move on to the kind of regional performance, they have the slowest metro level rent growth, the kind of top markets here. And I was particularly interested in the ones that were performing the worst or had the slowest rent growth over the past 6 months. Number one is Austin with negative 4%, and then Orlando and Portland are soon follow with negative 3%. A bunch of markets have negative 2%, including Atlanta, Jacksonville, San Antonio, Nashville, and Memphis. But number 9 is Miami. First time I've seen them on one of these lists for low rent growth.
Yeah, that's really interesting. Miami's been in like the top of the list for rent growth. So that's interesting how quickly that has turned around. Really, really fascinating.
Yeah. And so on the flip side too, because if you look on the fastest metro level rent growth over the past 3 years, Miami is the clear leader for fastest metro level rent growth. But over the past 6 months, it's a lot more colder climates, like Providence, Grand Rapids, New York, Milwaukee, Kansas City, places where it snows in the winter. Hartford, Washington, Washington, D.C. Yeah, it may not snow that much in the winter, and not in Tucson, but definitely in Detroit. And then
it can snow in Tucson.
All right, well, okay,
up
good.
in the mountains.
All
Mount
right,
Lemon. You can get some snow on the peaks.
So the only questionably never snowy area is New Orleans, which is doing fairly healthy with a 2% rent growth. And over the past 12 months, similar over representation, I would say, of the Northeast and the Midwest, which is something that we noticed early kind of in 2023 and has continued throughout this new rents, this kind of new rent growth environment post, the rent growth peaks that we had 2 years ago. But again, over the past 3 years, the story has been, it's still Sunbelt is dominates. Miami, Tucson. Oh, well, there you go. Say what you will. That's some consistent growth. Tampa, Orlando, and in New York doing great. And San Diego. And then Grand Rapids is the only one in the top for 3 years of growth, the only Midwestern market. All the others are some Northeast and Sunbelt ones.
Fascinating.
Yeah,
Matt, I'm pulling up I'm just looking on CoStar because I'm just curious of whether some of their market rent, their tracker, if they're marking rents declining in Miami, like Apartment List is, and excuse me. So I'm just gonna switch my screens real quick.
Well, just to fill in a little bit. Oh, you got it already.
Yeah, I thought I was gonna have it quicker though. So yeah, we've definitely seen it slide in, not the big decline that they're really talking about, but certainly has
Yeah.
come in. Looks like kind of peaked back here, April,
Hmm.
and that's where a lot of the markets did kind of seem to have peaked, and it's really been the supply has really been seeping in kind of
Yeah.
since April. It seems like across many markets. So
So
I don't see the declines,
yeah,
necessarily like
it's
apartment
not in the
lists.
negative.
I mean,
Yeah.
because again, this is just going out.
And
Oh,
then just to
This
use,
this is quite the time, Matt. Matt remembers this period well. This
yeah.
period of 2021 was just
Oh
like
man.
crazy, and more so than the watching the rent growth was the occupancy climb for a while too. But man, this we really slowed down.
Yeah.
2022, just after March. It's amazing. This is just a little bit after Jackson Hole's, not Jackson Hole's speech, but well, actually, yeah, I think this was right around that. But after the announcement, they were really increasing rates.
Hmm.
I mean, just, and I'm not saying that's the only thing that's happened, but I mean, we were
It
going
is.
a little
That's
bit
the
north of 45-degree angles here, and then it just kind of just leveled off.
and just to kind of bring
A little
things
bit more
back
growth.
to what we were talking about, like even before this, I keep thinking about risk. Bring it back to cap rates. Cap rates are maybe an expression of returns, but also maybe an expression of risk. Your hope
Yeah,
for growth is also
they
the
are.
risk of it not growing. And I always think of risk. It's just because I'm dramatic, I always think of risk as like a meteor or an earthquake or something even just dramatic where like, okay, the building that you bought, like a really weird business moved in next door. And now like, well, yeah, that's a risk that you took that, so it was going to attract the wrong crowd. Maybe crime goes up or something, dramatic. These are really, but just the slow moving environment that moves away from where you think it could be, whether it's rents moving, and the 10-year treasury moving, like that's a risk in and of itself. And just because it's not a forest fire doesn't mean that this is risk. It's the risk that your returns could go down. And here it is playing out from multiple directions for a lot of people for 2024. If risk looks a lot different if you have a longer horizon. And I think that that's what people are banking their hopes on, and a lot of people are keeping hold of things because they think they can make it past there. But
Matt,
yeah,
I would love to read your dissertation on what is risk, because it would include forest fires, bears, someone moving in next door,
meteors,
meteors.
someone moving next door.
I was listening and I was like, "What?" I followed what you were saying, but there are times where I'm
Be
like,
dramatic and fun risks that are fun to think about, but really it's like the banal, slower moving, less dramatic, sometimes less noticeable risks that creep up on you. That ultimately could be just as expensive. You can have insurance maybe for a forest fire, but for for some of these slower moving market forces, it's harder to wriggle out of.
it's true. It's the the boiling frogs. I mean, it's
Yeah.
the slow change, and then all of a sudden we find ourselves in an environment of where just this environment is challenging to say the least.
Yeah.
To make things happen. And again,
I read this. It's a best of LinkedIn. So it's all these LinkedIn posts that they highlight. And one of them was, they use the metaphor was if a rat knows, so they would do these experiments and they're, probably inhumane. If the rat knows it's going to be rescued, they will swim longer than if they don't know that they're going to be rescued. So if they do it every day and then they'll swim longer.
Oh,
How long are we going to swim, and are we going to get rescued? It's my big question. And it cuts both ways. Like you gotta be hopeful for the future, but you gotta be realistic about the real risks.
yeah. I'm trying to find like the other end of that analogy of like why you need the rats to like drown so you can.
Oh
make
no,
rats.
the point of that one was the point of that one. Oh no,
I understand what I understand.
They do experiments on that for antidepressant drugs is one of the reasons they actually do some of those similar
They
experiments.
have rats like simulate drowning on rats.
If they put them in a bucket and
And then
they
they
don't
give
kill the
them
rats.
antidepressants to see if they'll be like give them a little more
Yeah.
positive outlook on life.
Yeah,
Yeah.
and it works. I mean, it didn't work
Well,
for the rats.
isn't that what's happening, Matt, with the whole idea
Yeah.
of extending and pretending and,
Yeah,
kicking the can down the road and, hey, if we think rates will come down and hey, we're all in this together. I mean, that's the fact that, like many of the banks and the lenders and the borrowers are kind of in the same, boat. Matt, I don't know who said it first. You said it multiple times, if you owe the bank like $1,000, it's your problem. But if you owe the bank like, $100 million, it's the bank's problem.
Yeah.
Like this is like, it's a problem with the banks. And we mentioned earlier, it's like the banks are going to end up having to take haircuts on all of these loans. It's just like, there's not going to be enough there and to be able to restructure and do something just to get rid of it. They're just going to have to take a little bit of a haircut. And so they're all in the same boat and they want to give themselves time. And, whether it's a bailout or things, they don't want it. They certainly don't want to be like one of the first ones to go without the rescue plan, because they know if it gets tough enough, if there's enough outcry, that the federal government or the Federal Reserve will step in with some kind of action. Either lowering rates or some easy monetary or fiscal policy, some bailouts. Which is all scary.
It is interesting how much, we've talked about the little players and how they could be so dramatically, the imperative could be on them to enter the market as sellers and start to rebalance the market. But we may be seeing the rational decisions of eliminating risk come from sellers that are institutional, that have done the math and realize in a little bit more clear way and have the capacity to do that. So yeah, we'll see how things are unfolding. This is an exciting and interesting time. But it is risky. But we're, risk and opportunity, and hopefully we can find an equilibrium there.
Yeah. Well, make sure you're subscribed to the Great Capital YouTube channel. Appreciate everybody watching this episode, listening. If you are listening via podcast, Matt, any closing remarks? Any thoughts? Any
if you're I
hold on, stop.
Yeah. Okay.
How was Halloween?
Oh yeah, Halloween was great. I did not dress up. I was going to do like a pointy bearded devil, but I couldn't get my beard pointy enough in time. So that was a little bit disappointment.
But not long.
It's
not long enough. You gotta
not long enough to like curl and yeah.
You take a lot of time to have like a really strange long beard for one day.
I used to be able to do the villain mustache, but I can't.
Good stuff.
Yeah, how was your? Well,
I was still under the weather, so I did not make it out.
It was cold.
Didn't make it out. It was cold. I was as much as I hated missing going trick or treating. I was kind of okay. I'm just seeing pictures.
Traffic was similar, but I didn't see any like all-star costumes that that's like, oh really, bang on, really great ideas, but. Who knows? There was not as many Barbie costumes that like everyone was like, oh, I'm waiting for the Barbie costume. They must have timed that movie wrong because I didn't see that.
I was going to say, was that ever? But sometimes some of those themes that are like older, they come back. But has it just been like overdone? Did everyone do so much Barbie stuff for a while?
I don't know.
Like there's nothing. There was no other pop culture.
Maybe kids don't play. Maybe Barbies is not what kids play with anymore. I don't know.
Well, that is not true.
all right, okay, yeah, because I don't have you have daughters. I don't have daughters.
Yeah, there are plenty of Barbies, and I guarantee you the sale of Barbies has not decreased in the last year.
Okay, good,
for sure.
With some market sample.
No, one of my daughters was involved in a Barbie trading scheme a year before the movie, like bringing in Barbies, trading Barbies. One kid's not allowed to have Barbies. They're like, there's a black market for Barbies going on. No, it's the whole trading thing. Do your kids trade?
Not enough. I wish they did. I wish they did have some kind of racket.
Yeah. My she's 7. They do these like secret handoffs like in like the hallway, like behind the back. They like, and it's not like, I got in trouble back in the first grade for trading got caught up in like a pog ring essentially.
Okay.
And
Who was it?
yeah, to some
Ooh,
degree, right?
love it.
And apparently you're not allowed to have run businesses out of the school. And it wasn't even that. Like they're trying to, we were trying to make a little bit of money on the pogs. They're just like literally trading, Barbies, and this one girl's gonna bring another toy. They're gonna give her the Barbie. And anyway, one parent wasn't a fan of Barbies apparently, but teach their own. All is good. All is good. But the kids are trading. They're bringing in fidget spinners. They're bringing in little bracelets. All under the table. This is not allowed.
Pokemon cards.
Oh
you
yeah,
can't
Pokemon.
you cannot suppress markets. I think that's a hardcore lesson that everyone should learn.
Prohibition doesn't work, Matt.
Yeah,
it's true. Markets will find a way, and they are finding their way into the first grade.
What are you doing? Price discovery.
Exactly. What is a fidget spinner? Well, what's your fidget spinner look like? I don't know. Let's see. They're making bracelets anyway. So the again, we ask ourselves why GDP is at 4%. Why is growth so strong? Are you kidding me? We've got economic activity in the first grade. They're slinging bracelets and Barbies.
Yeah, project.
I mean, that stuff that adds up. That adds up, man.
Every Pokemon card, every
how much
yo-yo.
Yeah, a lot of value in those cards. Haven't heard much about NFTs recently though, Matt. How's your NFT portfolio looking?
Thankfully and gratefully non-existent. I just heard.
I'm glad I've only made some. I never actually bought any.
That WeWork, I think that WeWork, didn't they declare for bankruptcy? I don't think they're specifically connected with NFTs, but there's a lot of, they're going to be under a lot of pressure right now. Although I heard that that Bitcoin is jumping.
Yeah, I know. Not surprising.
For different reasons than it was before, but yeah, interest rates are high in there, and Bitcoin's up now. Could this be a tacit acknowledgement that the economy is in for something shaky, and you want to get into Bitcoin as an independent asset? I don't know, but it could be.
I haven't done the analysis recently. I think the problem with Bitcoin is people aren't really sure, like, other than an asset that can be kind of cross-border, move it around pretty easily. Because it's definitely not anonymous, but it's not necessarily been a good. There's not enough data to say it's been a good hedge against inflation.
Okay, that's what I was wondering, like the gold substitute or something like that. Like,
but gold really hasn't been a good hedge against inflation either. So
yeah.
I think we need a little bit more time.
Yeah,
see how that looks.
Yeah.
Well, Matt, looks like the rest of the team is packing up. It's been a good day at the office.
That's right.
Well, make sure you're subscribed to the Great Capital YouTube channel, hooking into the podcast. If you are an investor, you want to make sure you don't miss out on the next Great Capital deal. If you have to be accredited, go to greatcapitalllc.com and check that out. Check out the reports that Matt's been posting. There'll be a report button. You can go to our blog, check it out there. Just keep in touch with us. Matt, we have anything else going on that we need to announce?
In about a week and a half in the Indianapolis area, we are having our multifamily networking hour at Pins Mechanical in the Bottle Works district. So if you're in town, please go there.
See you. December 14th.
Yes. Be there. We will
December 14th. Yeah, that'll be a good time. Thank you for reminding me. All right, everyone. Thanks for watching the Great Report, and we'll see you in the next week.